Now we're going to go more into wages, where are real wages, where are nominal wages, and what does that mean for spending when you start looking at retail sales, which came in much better in October. As we were discussing, we thought October retail sales were going to be very strong, but some of that is going to be to the downfall of November as some of that spending was pulled forward. What we still see so far a fairly stable spending in November, but again, it's just going to be a matter of what is it against expectations, and we think expectations have started to come down a bit given how much was pulled into October. So when we start looking at the mix shift impact, mix shift effects always have to be taken into account with an average hourly earnings, but levels of inflation adjusted earnings, which is this top line, still largely around pre-virus trend, despite the year-over-year growth decline. So even though you're seeing hourly earnings coming down on the real wage side, when you go back through 2008, the U.S. real average hourly earnings at the top end, you can see that it's still elevated versus where we were pre-COVID. The problem is, as inflation continues to go up, and the question is going to be how do wages pick up, this should normalize and average out over time, because as you can see from the hourly earnings, you get these big spikes, and they're just not as big at the top on the blue line when you start looking at that average hourly earnings side and trying to normalize it to get an idea of where things should be, not only just on a year-over-year level, but on a continuous basis. But we have been experiencing inflation over that time period, and even though they'll tell you it's been less than 2%, it hasn't been, which is why it's just inflation catching up. And that's when you start looking at the real wage side. As this inflation starts to catch up, that's when you're going to start to see that pressure, and it'll pull back down to really those 2019 levels. So then when you start looking at the retail sales, so October retail sales stronger at 1.7% versus the estimate of 1.5%. So again, still better than what the expectations were. And that's what, again, that pull forward that we were expecting out of November and December and into October and November. It's just a matter of how much of it came from November into October, which I think is fairly sizable when you consider that many people are now very cognizant and are trying to avoid supply chain issues. Delays. I know I at least get emails from different websites that I belong to saying like order now to ensure delivery by Christmas. Order the latest December 1st for guaranteed holiday delivery, or December 9th, depending on the company, depending on their supply chain and logistics. Which again is why a lot of this is happening now, and we'll see some of that drag as we go through the remainder of the year. So then when we start breaking this down, the U.S. Treasury deficit, because a lot of this was driven based on how much was being spent into the market, how much was being pulled through. And the reason why we're going to talk about this when we're talking about retail sales is because when we look at what has happened with Yellen saying that we have to start being very serious about where the debt ceiling is on December 3rd, because by December 15th, there's going to be a problem. Now, the deficit isn't as bad as expected because federal receipts have gone up, which again has helped keep us away from where we were in 2021. But you can see still at a very negative level when we're looking at where is this going to go going forward, as the 10-year government benchmark real interest rates continue to worsen, as rates stay fairly flat and inflation goes up, which again creates this real interest rate problem. All the while, bank loan deposit ratios continue to go much worse, which just means that there are less loans being made as more deposits are coming through, which is also increasing the amount of RRP, or the reverse repo purchases that are going into the Fed, coming in today at about 1.53 trillion, which is the second highest ever, and sets up very well for a push to be over 2 trillion by the year end, because the banks are just sitting on so many deposits that they don't have enough loans or places to put that capital. So then when you look at the loan to deposit rate based on small versus large, you can see that the large banks are sitting on this huge swath of capital, and it's just where do they put it? They're not lending it. So if they're not lending it, well, where is it going? Well, it's sitting there, and it's just a drag on their balance sheets, which is why they plug it into the RRP and get at least 5 basis points instead of nothing. which is why we talk a lot about where inflation is versus where rates are that you're earning within the bank, savings, CDs, money markets. Back in the 70s and 80s, early 80s, you could get 13%. Here, you're getting 5 basis points, and inflation, if you apples to apples the calculation, is at 14%. If you use the new calculations, that's 6.2%. So the spread is just unreal when you think about how much is being lost by just holding cash, which is something that is being shown here. But household and debt and credit outstanding has gone back up after coming down for an extended period of time, because there is cheap debt out there, that it is cheap credit. And as people have drawn down their savings, as we've been talking about, that is now pushing them back onto the credit side as they reissue a lot of this credit. Now, when we start looking at, people feel pretty good about the situation. When you look at their financials are normalizing, but still better than they were. So more Americans quit their jobs. The quit rate blew at a record 3%. And then the wages for job switchers is continuing to go higher, because people are sitting there saying, I can work in this restaurant, bar, and just a hotel, or I can go across the street and work in that one. And because I'm changing jobs, I'm going to get $3 better an hour. You're going to do that 10 out of 10 times, especially because you have the experience, you have that movement. And those are some of the shifts and those bell ends that we continue to see. It's just, how long is that going to continue? And we're starting to see it level off a touch when you look at the new job postings have flatlined a bit as people are further in this route. But at the same time, November and December haven't really been the best times to get a new job. So then when you look at the discrepancy on wages, lowest earning quartile is seeing incredible wage growth relative to the highest earning quartile per the Atlanta Fed at 5.1%. Former cohorts growth is fastest since 2002. So you get an idea where the people at the top end, so the highest quartile is getting paid less and seeing less wage growth as their living expenses go up. So they're seeing their disposable income go down, while the lowest earners are seeing their wages go up, but they're also at risk of or eating the biggest piece of that food component that we spoke about in the geopolitical show. So again, there's a lot to look at when you're thinking about how is that food going to drain this, and that's when you start to see these impacts from, while wages are going up and is great, it's also getting sucked back into the market when you look at that inflation and underlying cost, which is why when we look at the dashboard that we talked about on Friday, every single metric is just blowing through the target of about 2% from the Fed. And the reason why they're starting to get concerned is because when you look at sticky inflation at 3.2%, trimmed mean CPI at 4.1%, median CPI at 3.1%, and then the trimmed mean PCE coming in at 2.3%, no matter how you cut it, we are seeing an accelerating amount of inflation, and that is the underlying concern. But at the same time, when you look at the monthly change of the average hourly earnings, it continues to come down as inflation is ramping up, especially on the sticky side. You see rents going up, food going up, and we still haven't even seen the real heating bills start yet. That's when you start to see some of this pain on the hourly earnings side. Now, looking at all of the wages together, you get an idea that the first quartile or the lowest quartile is breaking to those highs. Second quartile seeing some similar growth, still not where we were in 2008, but again, starting to see that crawl through. While third quartile and fourth quartile are moving lower. Third quartile starting to flatline, but still not seeing that growth. And those are the individuals with the most disposable income, which is where we see some of that being shaved off when you're looking at how is spending going to be going forward as savings are drawn down and prices continue to go higher. Which is where you, again, following that back through, the share of total spending on food, gasoline, and utilities by income quintile. So the first quintile, the lower income household, spends a larger share on food and energy than the higher income. So the first quintile spends 28%, while the fifth quintile spends about 18%. So again, even though wages are going up, it's being pushed right back into the market in terms of food and energy, which is where, when we look at where those prices are going up, The reopening components have normalized a bit, but non-reopening components, 78% continues to go up. Energy continues to be an issue, especially as we shift into heating season, and heating oil is not going down. While food away from home isn't an issue, the non-reopening components, that which is including all of those, food for local, cooking, like cooking at home, all of these key components in terms of everyday goods continues to grind higher, and again, draining from the additional wages that are being pushed through, but also, again, speaking to that cycle effect where as wages go up, costs of goods go up, and as costs of goods go up, well, the price of living goes up, which means that wages have to go up. And again, you get that circular movement through the system, which is why when you look at that sticky CPI keeps getting pulled up as flexible CPI breaks to the highs pretty much the highest levels we've seen since the 70s, which is going to be that, again, that pull through for that sticky. It just takes time. There's a lag behind it, but given how extensive this move is and how prolonged it's been on the flexible side, that again will move into the sticky and become that overarching problem, especially as we continue with this rampant amount of not only QE but low rates. So then when you look at price pressures, again, this is the same slide we talked about earlier. Price pressures are hitting everyone, not just on the coast, but also as prices increase. And that hurts because if you think about the middle of the country, that was where the living expenses were the lowest. You had the best cost of living. You had the best, work-life balance in terms of just what you could do and how far that dollar could go. And you could see how that is closing its gap. But even with that still happening, the CPI versus PPI is still broadly separated, which means that there's more prices that can get passed through as we continue to see prices paid versus prices received, as companies are going to continue to try to push this through and try to recover some of these additional costs. While productivity is going down, and again, this is something that happens coming out of recessions. It's not unheard of. But you're hiring new people that may have changed positions, may have changed industries, and so you have to train them. So the productivity comes down, but you're paying them more. So you're getting less from them, even though you're paying them more money. And again, that creates that issue for the corporation that is trying to get that. You will get a snapback, but it'll take time as these people are trained up, as we've seen from De La Rosa, who's talked about training his people on the ground, and how when you talk about training on the ground, it takes time. You have to sit there. You as a supervisor training, you are doing nothing, because you're sitting there watching the person you're training, but you're paying both people to do one job. And again, that's where you get some of that drag, which then will come and increase on the other side. So then when you look at the Atlanta Fed wage growth tracker overall, here's where you can get the wage tracker tick down slightly in October, now at 4.1% versus 4.2%. Still high, but starting to get that drag down because of the weakness in the highest quintile. So then when you start looking at, well, what are the different categories of spending? Housing, obviously the highest, but then you have groceries. Where are housing and groceries growing? Then you look at utilities. Where's the price of electricity going? Then you have cars. Where's the price of cars going? Health insurance. Where's health insurance going? So you get an idea that a huge chunk of this pie chart is going up in one direction, which is why that sticky side of the inflation is going to become that overarching problem. But then when you look at when do people start to reject price increases, when does the consumer start to push back? And consumers, while still seeing some strength in terms of what their Google searches are for, it's starting to roll over, and we expect that to continue as people close down their shopping for the holidays and you start to see some of this normalize. But when we look at the strong retail sales in October, as was indicated based on the Google searches, you're starting to see, again, this is still elevated. Gasoline stations, obviously still strong. And remember, this is nominal dollars, and gasoline prices have gone through the roof, so gasoline prices are up. Electronics, as we talked about earlier with University of Michigan, saying this is the worst time to buy Large durable goods, housing goods. Why? Because prices are so high. So electronics, appliance stores, store retailers, building materials, all of these things, motor vehicles, parts and dealers, all of these are seeing massive price increases that are so far not being rejected. As you can tell by the University of Michigan, people aren't happy about it, but they still haven't stopped. And the question is going to be, when do they stop those purchases? And that's going to be, again, that's more looking as a 2022 event, but a lot of this is being pulled into October, out of November and December. So we think that slowdown starts earlier and then only accelerates into 22 instead of in 21. And this is one of the key reasons on why you have this beholden buyer, is because inventory to sales still remain at near record lows. And you had a little bit of a bounce for the retailer side, but now as you had people buying for the holidays, what little amount of inventory was made up is now gone. And that's where you're starting to see that go up. Sales have gone up. So obviously when you look at the numerator versus the denominator has gone up, and the inventory side has come down. So again, you're seeing this worsening side on the inventory, but U.S. retail sales, when you get an idea of just how high it is versus the trend, it continues to move up on a nominal basis. And then when you look at U.S. non-store retail sales, still above 2020 and trending up, the pace is starting to slow down, and we expect that pace to continue to slow into and through November into December. And then when you look at travel and personal electronics, categories where consumers expect prices to increase this holiday season, you get an idea of just where those prices are increasing. And that's not, we've seen that across everything, which is, again, as those prices go up on the nominal level, it just means that retail sales, as people continue to pay them, will continue to go up. So that's where you have to see that backdrop between what is real sales and what are nominal sales. And then when you look at consumers' responses to the rising cost of holiday gifts, look for more deals, still very high. Look for lower cost alternatives. That's increasing in terms of, again, going down the quality stream. Spend less on themselves. That is increasing, while reduce my regular spending is about half. So you're starting to see people balk a bit. And you're starting to see some adjustments with how spending is happening. And that's why when you round out the merchant wholesalers, you're seeing merchant wholesalers sitting on a bit more inventory, because you're not seeing some of these movements at the bigger side. Inventories are coming up, sales are slowing a touch, and that's a little different than what we're seeing at the retailer side. So again, these are some of the different pinch points of are things going, where do retail sales go to. October was as strong as we were expecting it to be. November, we expected to be slower. December, slower than November. And then that pressure continues through Q1 of next year. So now we've gone through that, we want to round it out with employment and housing and go through what are some of the underlying issues that we're seeing on the employment side, or the positives really, and then the negatives on housing and how that's going to impact inflation well into 2022.